So welcome, guys. I want to thank you all for jumping on the webinar today. We know you guys have all got busy schedules, but you're also very keen to understand the state of the market and maybe get a bit of perspective from how we're thinking about it and how we're handling it moving forward. But before we do that, I'm going to hand it over to Ben to just give a bit of a, we're looking a little silly on today's webinar with our mustaches, but we have a reason behind that. So Ben, over to you, mate.
We do. Thanks, Reed. Hey, guys. Look, we're all doing Movember. So we've got, the script says I'm supposed to call them hideous moustaches, but I think that's a bit overkill. Maybe they're nice moustaches, luscious. I'm not sure what the word is, but look, we're raising money for an important cause. It's men's mental health. So Josh is going to pop a link in the chat. If you want to find out more about it, you can go ahead and click that. If you want to donate, go ahead. But that's why we look a little bit silly. So with that said, I will pass it back to Reed, and I think we're probably close to getting into the presentation here.
Yeah, I think let's start sharing and we'll get cracking. So again, hi guys, I want to thank you all for taking some time out of your day to tune in to talk about the state of the market. And the whole reason that we're here really is to talk about, what's happening, right? We've had a dramatic shift in the economy over the last 12 months. And what we're going to cover on today's webinar is we're going to talk a lot about where we've come from, where we are today, and how that impacts multifamily investing, and then where are we going? And obviously, we're all investors here, but we're, in addition to what we're going to be talking today, we're going to be talking about how we at RSN are being prepared for this and how we're handling it in today's environment and what we think the next 12 to 24 months are going to look like. And really, to be honest, what presents some huge opportunities for all of us as investors. Now, depending on the response we get from today's webinar, this is one of the first webinars we have done as a group here at RSN. And if you do like it, we may do more of these. So we do like to hear from all of you. If you do find these sessions valuable, please shoot us a quick email and let us know. And with that same token, if you do think there's any constructive criticism, any feedback, please let us know as well. So getting into it. So what we're going to be covering today for the next 30 minutes is we're going to, as I said, we're going to be covering where we've come from. We're going to look at what the historical data has said, and that leading us into where the decisions that the Fed has made today. And then we're going to look at how's that impacting us as investors in the multifamily space in real time. We're then going to summarize and talk about where we're headed in 2023, and that should probably take between 20 to 25 minutes. And then at the end, we're going to do a live Q&A with all people on this webinar today for about 10 to 15 minutes and answer questions live. So with that being said, if you do have any questions, please, the best way to do that and get us questions over to us is hit us up at reed@rsnpropertygroup.com. We'll be able to answer all of those at the end of the presentation here in about 25 minutes. So with that being said, we're going to get into it now. For those people who are new to RSN, I really want to quickly just give a brief overview of what we do, right? And then if you've just stumbled across this webinar, most of you know what we do, but I just want to quickly recap. We are a value-add multifamily investment firm. We are focused on acquiring assets across many different strong MSAs throughout the United States. We're in Central Texas, Phoenix, and we've recently just broken into the Greenville or into the South Carolina market. And we, to date, we've been in business for over 8 years. We have about 685 million of total portfolio acquisitions. And we're really, our investment strategy is to grow investors' wealth by investing in, workforce housing. People who earn between $40,000 and $60,000 a year. We like to provide, clean, safe, affordable housing for those folks. And we're going to talk a lot about that, later on in the presentation about, our investment thesis. But for those people who don't know who we are, just a quick highlight of that. So with that being said, I really want to quickly cover some of the key team members on today's call that you'll hear from a little bit later on in the Q&A session. Obviously, there's myself. I'm the founder and CEO of RSN Property Group. I have my good friend of mine and my business partner, Ben Gray, with me, and he heads up all the sort of, he's a chief operating officer of RSN Property Group. We have Josh Oaten, who is what I like to call the Swiss Army knife of everything Phoenix and Arizona related. He heads up asset management, construction management, acquisitions in that market. He does everything related, to Arizona and Phoenix. We just recently welcomed Austin DeGue, and he is the head of acquisitions. And Austin is actually located in Central Texas and oversees our acquisitions really in Texas and in the Carolinas. and because he hails from that part of the world. We also have Abi, who is an analyst who supports both Josh and Austin and myself in the pursuit of really good deals over the last 12 to 18 months and moving forward. And we'd also love to introduce Juan Espinoza, who is our head of investor relations. Now, these are just some of the key members on our team for today. We have a lot of other people who support us, CFOs, bookkeepers, but these are the crux of the team. And just wanted to give a face and a name to all those people, so in case you interact with these guys in the future. So with that being said, I'm going to hand it over to Ben, and he is going to take us through where we've come from in terms of looking back at history and how that's impacting us today.
Well, fantastic. Thank you, Reid. Well, look, jumping into it, guys, the elephant in the room is the looming recession, and we'll touch on that later. I want to actually open with a story about how the last two recessions impacted my family. To begin with, my brother was heavily involved with stocks and money management in the dot-com crash, and his net worth basically zeroed out because he was overextended, didn't protect himself against the downside. He got back on the horse quickly, though, and acquired a huge portfolio of single-family homes in California. And of course, the housing market then went on to crash in the late 2000s. And my dad in Australia was a wealthy business owner and real estate developer. And in the late 2000s, he sold his business to focus on real estate. My mum and dad also parted ways. She took her 50% in cash. He took all of the properties and the debt, really ramping up his leverage to unsafe levels. He thought Australia would be insulated from the US. Alas, he was wrong. And despite having ample cash on hand to ride out the storm, the bank called due all of his loans and essentially bankrupted him. And as I say this, I realize I'm probably scaring a lot of people out there, but the lesson here isn't that everyone goes bankrupt every time there's a recession. It's that if you don't take heed of the road ahead and you don't prepare, bad things can and will happen. And that's exactly what we're here to talk about today. So as you might imagine, this has impacted me pretty significantly. The way I think about money, the way I think about investments, the way I think about risk. It hasn't made me passive. I still work very hard to grow my wealth and take calculated risks, but I'm conservative and methodical. For every 100 hours I spend making money, I spend another 50 thinking about how I'm going to protect against the downside and de-risk everything I do for myself and our investors. And Reid and I share a lot of these same philosophies, and we've baked them into RSN, and you're going to hear a lot of that come through today in this presentation. So with that context shared, let's jump into the state of the market, specifically where we've come from. And I'm going to start talking in regards to the extended period of effectively 0% interest rates. And when people talk about the 0% interest rates, they're talking about the Fed funds rate. And I'm oversimplifying it by saying this, but this is the rate that ultimately governs all other rates in America: mortgages, car loans, business loans, even loans between large financial institutions. There's been a heck of a lot of cheap money over the last cycle. And the last cycle has been a long one. If you look at this graph here, the white sections indicate periods of growth and the gray sections indicate recessions. Even if you count the very brief recession at the start of COVID, we're on the tail end of the longest economic expansion in modern American history. To say it another way, as far as cycles go, we're due a recession. The other thing I'm going to speak to here is quantitative easing. In response to economic turmoil in 2008, 2010, around then, the Fed essentially printed a bunch of money and infused it into the economy. And a lot of this money flowed into assets like stocks and real estate. And because of this, the last 10 years has been very easy for investors in all asset classes, including real estate investors of all skill and competency levels, to make money. But unfortunately, timing does not equal talent. And the next 10 years are not going to be like the last 10 years. We've got a rocky road ahead of us. You can see it right here. A small two-door sedan isn't going to get over this road. But if we prepare and get a four-wheel drive, we'll get over it fine. We need to adapt and prepare for the conditions ahead, not the conditions behind us or the conditions we wish we had. With that, over to you, Reid.
Thanks, Ben. So that's the first section of the webinar done for right now. We're now going to talk about, that was a history, and it was a very good history lesson for all those people on the call that may not understand, and definitely go back and have a look at some of those graphs. Very interesting data there. But I want to talk about where we are today and how the impact of the Fed funds is impacting us. So you're probably starting to see, as investors, probably negative reports all over the news. Some of this is probably clickbait. Some of this is hype and speculation, and oddly enough, some of it might be quite rosy as well, depending on what you look at. But it's all about context and bias, and depending on what you want to hear and who you want to hear it from. So it's really hard for us as investors to know which way is up and which way is down. And that's why you guys have joined us today, because we're going to try and break it down into terms of how we are seeing it as active investors in today's market. And I'm going to break it down into inflation. I'm going to break it down into rates. And then I'm going to break it down into how that's impacting us in the investment landscape today, specifically related to multifamily investing. So as Ben just said, we've had the highest rate of inflation since the 1980s. It's been the quickest increase in inflation in modern history as well. After we peaked at 9.1% in June, it has dropped now to about 8% today, which is fourfold above where the target rate is for the Fed, which is 2% for those people who don't know. Now, as we know, because we're savvy investors, inflation eats away at your savings. It eats away at salaries, and it hurts the everyday American. And that's why we like to all invest in real estate. But that inflation also, has impacts on housing, on food, on heating. We all pay the same amount at the gas pump, but salaries are staying stagnant. And so in March, the Fed moved to stamp out this inflation with aggressively raising rates. And I'm not going to talk about whether the Fed or have a commentary on whether the Fed's reaction on inflation, whether it's correct or whether it's wrong, it's been too slow or too quick. We're just here to report on the facts to date and how we're handling the current situation and economic conditions. Because let's face it, we're all just investors and we have zero impact on the market. The market will be the market. And all we can do is try and prepare as best we can and then react accordingly. So, which brings us to the next thing, rates. In 2022, the Fed's funds rate has climbed from 0% to 0.25% to over 4% today and is projected to be above 4.5% by year's end. And if you're reading between the tea leaves, it might even be as high as 5% coming into Q1 next year. This is the quickest increase in interest rates in modern history, as you can see in this graph. Now, additionally, in August, the Fed chair, Jerome Powell, or some like to call him J Money, they signaled that the Fed would continue to raise rates and keep them higher for an extended period of time in order to cool those pricing pressures which we're seeing in inflation. Now, if you listen to the last Fed meeting, some people thought that Jay Powell was maybe talking about pausing, but then he had to walk back those statements and say that no, it could be an extended period of time. But simply put, all this is saying that this is a historical transition in the debt market and is having far-reaching impacts on not only the economy, but also everyday Americans. So this leads us into our final sort of little segment here, is the impacts on multifamily investment landscape today. And let's face it, it is impacting us. It's having huge impacts, ramifications on the multifamily industry. We are seeing interest rates on fixed rate products increase across the board, on variable debt, all that sort of stuff. On our recent deal, if some of you investors have invested in our Greenville deal that we closed on, which was 281 units in September, we saw that coming. The interest rates rising quickly, and we went into a local bank and got a fixed rate term of 5%, and that's what we got when we got the deal under contract back in July. That same product today is now over 6.5%. I went back to that same bank asking them on a different deal, and that's what they quoted me. That's an extra on. If I did the deal in Greenville again today, it'd be an extra $330,000 of debt payments just in the space of like 3 months. Now, this is just one snapshot of the real-time reaction lenders are having in the environment and how that's impacting us at RSN and obviously, you guys on the call and other deals across the country. Interest rates are obviously tied also to capitalization rates. And the higher the interest rates are, like you can see in this graph, the higher the market cap rate is for certain types of product. And I want to explain this a little bit further for those people who may not understand. If you don't know, multifamily is priced based on, like a business, on a net operating income, or the net operating income that the asset produces. So the market cap rate is calculated from the NOI divided by value. So as our business is, we increase that NOI and we increase the value of that asset when the cap rates remain stable in a market. However, market cap rates are also tied to interest rates, and as interest rates increase, so does the cap rate of that particular market, meaning that the value of multifamily real estate is becoming cheaper. Now, as interest rates also rise, guess what else rises? The monthly debt payments, and that is having a big effect on operational cash flow. This obviously in turn is reducing the value of assets and the price that buyers are willing to pay for those assets in today's market compared to where, end of maybe last year or the last 3 years, which in terms of had a really incredible run in multifamily. Now, this I will say is having a big impact on the market. If you talk to any of the brokers or industry insiders, the headline is sort of one thing, and that in the brokerage industry, multifamily transactions is slowing down. This is mainly because sellers' expectations really haven't adjusted as quickly as buyers' expectation. Now, the whole multifamily market is really going through what I like to call a pricing exercise, where some multifamily owners are doing what's called a pricing discovery. They're floating their deals offline to see what buyers are willing to pay for them. We've actually been approached by a couple of off-market deals in our key markets, and what we're willing to pay for these deals is drastically different to what the seller's willing to pay. An example of this, we had a deal actually in Phoenix just recently, and the broker whispered $30 million to me. Now, $30 million on the current T12, that was a cap rate of sub 4%. Now, the most I could pay in the current debt environment today is between $25 to $26 million, nearly a $4 million decrease. Now, at the price of $25 to $26 million, that's $175K a door, which is actually really, really low for that area. I would have actually expected this type of vintage asset, trade for around $200 a door. But given where the debt market is today, I can't pay 6.5% interest rate on a 4 cap rate. And the business model just doesn't work. That arbitrage is too large. So right now, we are still trying to understand the rules of the game. There is a bit of a stalemate. And, as you saw on the previous slide, the headline from the real deal is, are the multifamily deals, dead, rest in peace, as they say. But either, what we are seeing is that you're either an owner that can ride out the volatility, or you're an owner who is forced to sell due to expiring debt terms, or, you've got to get a new rate cap. And so the only deals we're really seeing being done today are those desperate sellers. So more on that, we talk to a lot of different syndicators and investors in the current, in our current deals and other people who are doing deals across the country. And particularly those who have variable interest rates. And the same common thread is true, that rates are rising quicker than the implementation of their business plan in terms of renovating to increase rents. And I'm going to, repeat that. So interest rates today have risen so quickly that people can't keep up with the business plan, right? I can't renovate 100 units in 6 months to keep, rents going and thus keep, in line with the increases in the Fed's rate. So that means it's having impacts on cash flow and impacts on distributions. And I'm sure some of you guys are seeing that through your quarterly reports that just were released at the end of Q3 here. Now, the deals that we are underwriting today, due to the higher interest rate and the fact of the lower leverage we are forced to have to get, and I'll touch on this later, LP returns are definitely coming down. And something that maybe was, a 16% IRR, net to LPs, last year is probably now around the 13 to 14% IRR. Still really good returns, but given the debt cash flow out of the gate is, really non-existent because, and that's bringing down the overall returns of the deal. And again, I'm sure a lot of you are seeing a similar type of adage, because you're on other mailing lists of other multifamily operators and sponsors across the country. So with that being said, we're going to transition into our final segment. It's like, is where are we going, right? So we're seeing impacts today, it's slowing down. It's, the arbitrage between going in cap rates and interest rates are widening, and expectations are not being met from sellers, and buyers aren't just willing to meet the sellers' expectations. But the big elephant in the room for 2023 is going to be the R word, the recession. And it's not if we are entering a recession, it's a question of how deep and how long this will last. Odds are, and you listen to all the pundits, that it's in 2023. But if you take the definition of 2 quarters in a row of negative GDP growth, then you could argue that we're already in a recession today. The big thing I'm personally looking at is unemployment and jobs. And we still seem to be in a very tight labor market. Today, there's reportedly 11 million jobs, out there. You can go get, if you want a job, you can go get it. Now, before the pandemic, there were only 7.5 million jobs available. So not only do we have a change in labor participation since the pandemic, but we're also seeing more jobs available, which is a really interesting wrinkle to this entire thing, which I'm not going to pretend to be an economist. I'm not. I'm just commenting on that as a pundit. So I will say that the impending recession does scare a lot of people, right? It's because of uncertainty. And But recessions are part of every normal economic cycle. This isn't the first one, and this won't be the last. In this instance, I will have to say that this is not an unexpected, 2000 dot-com crash or a 2008, housing crash that is forcing the economy into a recession. It is inflation forcing the hand of the Fed to raise interest rates extremely quickly, which is having major impacts on the overall economy. And a recession is a byproduct of that action. Now, while they're trying to lower inflation, I do think that we'll see a higher likelihood than most pundits that inflation will remain higher for a longer period of time. So you'll probably see interest rates stay higher for a longer period of time as well. And historically, inflation tends to take longer to drop than the current consensus, I should say, or opinion would have you think. But I will add, unlike other recessions, we may very well be contending with higher inflation in parallel for a longer period of time than people do expect. Now, additionally, the last period of high inflation was in the late 70s and early 80s. And that's back then, if you look at history like we do, the Fed chair at the time, Paul Volcker, aggressively raised the Fed rates to around 20%. Now, this was extremely effective in lowering inflation, but that kind of rate hike, I should say, today is just not viable, because back then the debt to GDP was around 30%. Today, we're closer to 120%. And the increase in debt costs that the US government would have to pay if you went to 20% would effectively bankrupt America. And I actually saw another stat the other day that if the Fed rate went to 8%, the interest that the Fed would have to pay on its debt today would be more than the spending of all of Medicare. So the question isn't how long they can keep rates high without causing a debt cycle, which means that they keep printing money to pay for their own debts. There will become a breaking point. And the question on everyone's lips right now in the multifamily space is, if rates do stay elevated for a long period of time, at least in 2023, is when will we see cap rates starting to readjust? And again, talking to brokers in our active markets, we're constantly chatting with them, probably on a weekly basis, because things are happening so quickly in real time. We are starting to see some pricing expectations and those cap rates starting to adjust. For example, assets that are built in the 1960s to 1970s, there's been a flight to newer quality assets. And so those older assets are starting to trade in the high 4s to mid 5s, and even in some markets in the 6 caps, right? Where historically they might, over the last 2 or 3 years, they might have been in the 4 cap rate area. So we are seeing the Fed action on interest rates having an effect in real time on the housing space, particularly in the multifamily space. We're also seeing some new, not some, but new construction multifamily projects coming to a grinding halt across our target markets. I'll touch on this a little bit more, but for now, a recession is coming, and we as investors, have to deal with this. We have to learn how to deal with this recession, and then we'd have to learn how to capitalize on it. Because the old saying does go that fortunes are made in the downturns. But if you take action and obviously you prepare and protect yourself, you can actually ride out this storm quite effectively, and then also be in a better position to capitalize on it. So with all of that being said, all of the bad news over, I want to talk about some of the good news that we here at RSN, and we're investors first and foremost, like you guys. Actually, in my last 2 deals, I'm actually the largest LP investor. So I'm also looking to make sure that we're making money. And investors, we can make money in any market. We just need to know the rules to play by. And we're still figuring out what those rules are right now, and if there's any light at the end of the tunnel. But we're now going to talk about how we are breaking down and how we're fighting this and how RSN is moving forward. So first, we're going to cover 3 things here in this last section. The first thing is the fundamentals behind the real estate market. And the big headline is that on the long-term horizon, our incentive, we believe that our investment thesis is relatively unchanged. And that leads us into the second point is RSN's investment thesis and how we built to perform both in good times and in bad times. Finally, we'll talk about how our strategy at RSN has evolved and what investors should expect for us into the future to capitalize on these opportunities. And it looks like we've got something's going on the screen here. We'll get that fixed up in a little bit. But it looks like someone was drawing with a pen, marking up something.
Yeah, someone's managed to annotate. Wasn't me.
So, I don't know if we can fix that. Anyway, we'll keep, erase. Oh, can't do it. Sorry about that, folks. I don't know who did that.
Anyway, carry on, Reed. We can all see the slides, even if they're a bit hideous, and I'll try to fix it.
and it's probably one of our kids. That's exactly right on. So just fundamentals behind real estate, our investment thesis, and then how our strategy has changed. So they're the sort of last three things to cover here at the end of this webinar. So first and foremost, despite our opinion, despite the looming recession and high inflation, is that the story behind real estate as an asset class and the underlying fundamentals in real estate have not changed at all. People need shelter. We have a shortage of houses here in America. We actually have a shortage of houses across most of the Western world. And we are still not producing enough homes to accommodate the growing population. And depending on really which study you look at, I think somewhere here in America, they still need 3 to 4 million houses or multifamily units just to keep up with demand. Now, I will say that while there might be short-term volatility, at the end of the day, it's pretty simple. It's economics 101, supply and demand. And there is a shortage of something, then the price will go up. Now, the state of the market today and the upcoming recession is going to, in our opinion, greatly exacerbate the housing shortage, coming into 2023. Now, and the reason is because with higher interest rates, less people are buying and selling their houses. I know I bought my house in the pandemic and I got a really awesome interest rate of 3%. I ain't selling. Big home builders are pulling up stumps, so are multifamily developers. And the reason is because that new development is coming to a grinding halt because that variable interest rate on the construction loan is costing a lot more to service, which is causing a lot of projects to be shelved. Couple this with homeowners, again, like myself, who locked in low rates the last couple of years. Why would they want to sell and give up their mortgages at 2 and 3% and have to get a mortgage today with Freddie at 7%? This all means that demand is still not being met in terms of housing. And for us, we think that's great news as owners, as there should still continue to be more demand for rentals. Affordability is still also a big issue. And with less supply and stagnant wages, people will rent for longer. So transitioning into our second little summary here is the investment thesis. Our investment thesis today is deliberately built around the niche that performs well during a recession. And I've talked about this at length on a lot of our past webinars. If you are an active investor with RSN, you will know what we do, but I briefly will touch on it again. And most of everyone knows here, we specifically focus on value-add multifamily opportunities in landlord-friendly states. We obviously buy existing stable assets with predictable cash flow. And we really are focused on the Class B space. So we can provide clean, safe, affordable, modern workforce housing for people who earn between $40,000 to $80,000 a year. And we think by focusing on Class B assets, we're better insulated for major market corrections. Historically, in high inflationary periods, real estate has generally tended to perform well because it's a physical asset. Multifamily particularly performs well because we can raise rents in line with inflation over a 12-month basis. So we believe we are in a strong starting position out of the gates own to a deliberate way in which we've set up our business here at RSN. Now, I'm not going to go on and talk. We're not going to be making any drastic changes to that investment approach moving forward. I can tell you that right now. And we've been spending actually a lot of time thinking about how we adapt and thrive in a new world. And so high level, we still believe that our deals can return investors mid to low teens, doubling people's money over 5 to 7 years. I think high level, that is still fundamentally what we can offer. We are anticipating that along these lines, that we may see cash flow being a little bit of an issue out of the gate, and we'll be probably more focused on equity growth in growth markets. And this is obviously a direct relationship between interest rates versus going in cap rates. And obviously that bigger the arbitrage, the lower the cash flow. So we're also looking to maintain higher cash buffers in order to ride out our volatility and during unexpected circumstances. And we always like to over-raise on our deals to accommodate working capital fund. And this is really used as a hedge against capital calls so we can ride out volatile times. So if you do see that from us in the future, that's why we're doing that. Now, because our assets are obviously focused on cash flow producing, we do have strong cash buffers, but we like to make sure that we aren't trying to have to sell during, in a short-term period. So we typically hold between 3 to 5 years. We prefer to skew closer to 3 years. However, I do think as we're trying to ride out the next, call it 12 to 24 months, hold periods will extend from probably 5 to 7 years. And I think that warrants it because we're trying to protect investors' downside. Additionally, we're actually also doubling down on pursuing deals in tax abatement states where we can keep rents at certain limits, and in return, we actually get our real estate taxes wiped off. Again, this allows us to increase our cash flow, provide clean, safe, affordable workforce housing for the average Joe. And this also allows us to keep our cash buffers higher. And if you actually joined us on our last deal in Greenville, this was a tax abatement strategy. And for those people who missed out on that, an example on this particular deal, we had a $35 million deal. It was going to be kicking off about $500,000 a year in taxes. We were able to reduce that straight out of the gate to $150,000. But I can still also increase my rents because I'm keeping them below certain AMIs in that particular area. So we can have our cake and eat it too. And these are some of the strategies we are pursuing in order to react to today's economy. Now, deal flow is also another area of focus that we naturally want to be continuing to provide our investors with great access to deals. We already have excellent relationships with our brokers in our key markets, and we want to keep fostering those relationships. But we are seeing brokers calling us more often now. And hopefully we're going to be that first call, when a deal needs to sell quickly due to refinancing or operational issues. We're also investing a significant amount of time and effort into direct outreach campaigns to multifamily operators and owners as to secure direct off-market access in this current environment. We do think that is going to be a play moving here into 2023. But the big one is how we're responding to higher interest rates. And I just want to quickly touch on this before we summarize today. So today we are looking at low leverage fixed rate debt with flexible exit options. Now, we cannot predict the future, but we do think there's a high likelihood that rates will drop in the next 2 to 3 years. So we don't want to be locking in rates today. We want to make sure we want to have flexible exit options in the future. Now, since debt is expensive today, instead of our usual 65 to 75% leverage, we are now looking at 50 to 60% leverage in order to get at the lowest fixed rate debt possible straight out of the gate. We're also underwriting now to not take any leverage on the CapEx, and we're going to try and raise more of that from equity. And this does mean that we're obviously raising more in total, which does reduce overall returns, which goes back to what I was saying earlier, that a 16% IRR for the last 2 years may now be a 13 to 14% IRR, still a good still a good return. But the reason that is because we're raising more money to keep a cash cushion and not trying to get too over leveraged. And for all those of you who've been investing with me in the past, you also know that we actually have a cardinal rule here at RSN that we never underwrite to a refi over a 5-year hold, but we're actually taking a closer look at that. And the reason is that we're trying to hedge, that scenario that rates will drop in the next 2 to 3 years, or we think that they will drop. And if they do, we want the flexibility to be able to pull out, pull out future equity and obtain a lower interest rate and get us back up to that 65 to 70% LTC mark, which we think is healthy. Now, with that being said, we're also looking at assumable deals, assumable debt deals, I should say, where the operator maybe has locked in a decent rate 12 to 24 months ago, and then they want out for some reason. We think we can swoop in and take over, having lower interest rates and still plenty of meat on the bone. But in conclusion, here we're going to wrap up here. There is opportunity in every crisis. The recession is going to be tough for a lot of multifamily operators. As we mentioned earlier, we are starting from a position of strength with our business plan and hopefully our investment approach. We have a solid plan in place to adapt and adjust as changes happen in the future. And more than that, we know that we'll need to make more adjustments in the coming weeks and months as we see how the Fed continues to fight inflation and thus impact the debt markets and how that plays out in real time for us pursuing deals. We also do anticipate to see a number of multifamily operators falling to some sort of strife over the next 6 to 12 months. Maybe I'm unable to service the debt, maybe trying to reach for rent expectations that just really are outside their tenants' base expectations, given the high inflationary environment. Or maybe they're just inexperienced operators that can't deal with delinquency, potentially even supply chain issues. And this is where we really think there's opportunistic times to pounce on deals. And this is why we are continuing to underwrite. We're continuing to make offers, and we think that make offers at where we think deals will work, and just stick around the hoop because rebounds will occur. It's just a matter of time. So in summary, we see a lot of changes ahead, a lot of uncertainty, and people don't like uncertainty. And that's why you've all joined this webinar tonight. However, you can rest assured knowing that we are prudently watching the markets and making the best decisions for you all as investors. But we truly do believe this is a time, in this time of uncertainty, there would be some great deals to be had. And we're just really looking forward to hopefully sharing with you those with you in the future. With that being said, it is now 2:36 p.m. We are going to go to a live Q&A. I'm going to check my email here. Ben, I know you probably have some questions as well on your end.
I do. We had 5 questions come in before the webinar. And as you know, we've decided to give one of them to Josh and one of them to Austin. And everyone be nice. This is their first time on camera here. So hello, Josh. We're going to start with you first. And the question is, what are brokers telling you they are seeing in terms of transaction volume?
Sure. Thanks, Ben. I mean, in speaking with brokers across the Phoenix market specific, most are coming to the same conclusions that transactions have slowed significantly from last year, but are currently remaining steady at this time. So we're coming through a period where debt adjusted significantly in respect to cap rates, but seller expectations remain high. We're now seeing seller price expectations come down in line with cap rates and debt funding based on property vintage, as Reed mentioned earlier. Brokers are telling me there is now a vast range from 2000s vintages trading at or below 4 caps to 1960s or earlier builds pushing up around 6+ cap rates. With that being said, most brokers I'm speaking with believe transactions will kick back up again in the spring of 2023 following the holiday season.
Awesome. Thank you very much, Josh. Next question is for Austin, which is, what are your thoughts on the US debt and interest rates remaining high?
Yeah, of course. So as Reed and Ben touched on, the US debt to GDP ratio today is much higher than it was in the 70s. So the Fed is simply unable to raise rates to those levels because of their current debt obligations. You know, this whole situation boils down to one thing, and that's inflation. The good thing is we're starting to see inflation cool down. Higher rates have weakened demand for US homes. The mortgage market has come to a halt, and the price of oil is down from its peak into the mid-80s per barrel. Many economists do expect the Fed to hike rates a couple more times into the new year, but then they will likely put things on pause. Whether they hold rates there or begin lowering rates is dependent on the inflation picture, but we're confident that we're closer to the end of this Fed hiking cycle than the beginning.
Cool. Good answers, gentlemen. Thank you so much. And Reed, we have 3 questions for you before we go to your email questions. First one is, will the rate increase still make it possible for deals to pencil out with respectable targeted preferred returns for quarterly distributions?
Yeah, I think that to what we were saying earlier, historically, and it's just a little bit of context here, we're all in value, or you guys are in value add multifamily or value add self-storage or value add something, right? Typically, you know, over the last 5 to 6 years, we have gone in with an arbitrage, meaning you might buy a property at 4 cap and you get interest rates at 5, you know, maximum 100 basis point arbitrage. When that arbitrage increases, and so and just like the reason we go in with an arbitrage is because we believe in our value add business plan, and we're going to right that ship and bring our stabilized cap rate above those interest rates, thus cash flowing, right? That's historically, you know, somewhere between 50 and 100 basis point arbitrage. That arbitrage today, like I mentioned earlier, like on that deal we got on off market in Phoenix, was $30 million. I would have probably paid $30 million for that at the end of last year when interest rates were at 4.5% because the arbitrage is there, right? Today I can't because interest rates are 6.5%. So the arbitrage is a real issue when you're starting to blow out above 150, 200 basis points. That will impact if you're seeing deals getting done today, not necessarily just with us, but with other folks, you will see cash flow becoming tight, right? And so you may see the first year where there may not be any cash flow, right? You may have an operator that over raises and pays back investors their own money. You know, we're not going to speak to any of that, but there's different ways you can do it. But I think what you have to be focused on is, do you believe in the fundamentals of real estate first and foremost, and do you believe in the long-term equity growth of your deal, and is your money best place in a physical asset or sitting in the bank, with inflation eating away at it? So to answer your question, it depends on what deal you're in right now or what deals you're seeing. If you can get a deal that has a lower arbitrage between interest rates, you can get call it a 6% interest rate fixed, and you're coming in at like a 5.25 cap, then that arbitrage should work, right? If you truly believe in your value add, and hopefully there should be no really disruptions to your cash flows. But the problem we're seeing, is what I mentioned earlier, was interest rates have increased quicker than the implementation of business plans in the last 12 months. And thus you're starting to see debt service go up first and foremost, rate caps are being hit, less cash flow left over, and your business plan can't keep up. So what are you going to do? You're probably going to stop distributions to investors. That is more prudent and keep conserving cash than it is to try and have a capital call. So a lot of stuff was just said then. Hope that answered that question for that investor.
Awesome. Thank you. And the next one is, are you seeing rents stagnate in some of your markets?
Yeah, I think I've got a couple. I'm seeing a couple of questions here about rents, both on the chat. And so, look, I think there's going to be some stagnation in rents, right? As I mentioned earlier, cost of the fuel pumps going up, food's going up. You can't just rental rates just can't keep going up. And we've had a historical growth, double-digit growth. Some markets, 20% growth in the last 24 months. I think that is now going to be revised back down. I think you're going to see stagnant rent growth, maybe a little dip. I don't think you're going to come back the 20% that we've seen in some markets. I think you might come back maybe 1 or 2%, but you'll start to see a leveling off. What we're seeing in the value add the deals that we're buying, we bought a deal in Phoenix early in the year. We're still seeing lease trade outs of $600-700. So in place renters where they're renting at $700 a month, and now the same thing is at $1,400 a month. That's still true, right? So you're still seeing your average 1 and 2 bedrooms, $1,300, $1,400, $1,500, $1,600. That's still okay. I just don't think you're going to see $1,600 go to $1,800 in the next 12 months. But I think you're going to, with your lease trade outs, bring everyone up to that market. And that's what you need to be focusing on. So really, really looking at what your in-place rents are today to make sure that you believe in terms of, okay, well, maybe I could have got $1,500 for that one renovated 1 bedroom 12 months ago. Maybe that's dropped down to $1,425. It's not a massive drop, but it's above the average 1 bedrooms on the property today, which might be $1,000. There's still a huge lift that you can get there. So it really comes down to the deal, and it really comes down to the rent roll and how the existing manager has either maximized the rents or hasn't maximized the rents.
Great.
I've got another couple of questions here in the chat. So yes, the webinar will be recorded. That's an easy one to answer. Apparently, Arn's talking about 2 days of rain. Thank you, Arn. How realistic is continual rents? I think we just spoke about that. Are you moving forward with the current renovation of new deals, or you're holding to still something else? That's a very good question. So, yeah, currently today we personally are not full noise on our renovations. On the exterior, we probably are, because we're trying to rebrand, and that work is you need that to happen to give online marketing a chance to reputation to increase and all that sort of stuff. So your exterior stuff, rebranding, new signage, updating the pool, maybe giving a lick of paint. We just put a mural on one of our properties. Those little stuff, it's not big dollars to come and make it look sexy. We're probably still spending that. What we are seeing is maybe we're not going as aggressively on our turns per month. We're trying to keep assets full, right? Because usually what we are seeing, and on the flip side, is delinquency is still being a problem across the country post-COVID. So we are, evicting tenants, and we're trying to keep up with the renovations, but we're now sort of maybe turning the dial a little bit. And this is not just in today's environment. We've been doing that for the last 6 or 7 years. Every time we look at how much renovated product we have on hand, we make a decision at executive level, say, well, if we've got 15 units that are renovated, with stainless steel and granite, when we're coming into the slow leasing season, we need to stop renovating, right? We just need to pause. That's still true today. And that is an organic thing that you will look at and should look at as an operator and as an investor throughout any deal, throughout any market conditions. Today in particular, it's no different. And we are maybe seeing, maybe not necessarily the full hog of our renovations. We may do, say, 5 full hogs, and then we may do a partial. So we're sort of just testing the knobs here as you get your hands wrapped around an asset. It just depends on where you are in your business plan. So hopefully that answers that question there. Can you talk about the approximate relatively monthly volume of prospective deals you may want to look at in the typical month in Southeast USA? 1 month, 2 months, relatively volume of prospective. So I think they're asking here, how many deals are we looking at in total? Yeah, like that's quietened down a lot as well. As a team, with Arby and Josh and Austin, we are across a few different markets. So we have seen that volume go down. But to what Josh was saying earlier, when we talk to the brokers, you are seeing, the quote unquote off market, listings coming around for that pricing pricing exercise. But to that example I gave earlier, what we can pay today, given the debt markets, is drastically different to what the seller wants. I don't necessarily disbelieve that the seller can't get a $30 million for that particular deal in Phoenix. If we were in 2021, we're not. So we are seeing it slow down, and some brokers are saying it's quiet. And that's probably twofold. One is that we're trying to see where we're going. 2, we're just around the holidays. It's always slow around the holidays. But I think, given to what Josh was saying earlier, come NMHC next year, we start get through this holiday season, we get through the last Fed meeting at the end of the year, I think there'll be renewed optimism coming out of out of 2022. We always just had the midterm elections as well. Around any election cycle, there's always a bit of a slowdown. And our thesis here at RSN is that we need to still be active and still underwrite and still make offers where we think they make sense, even if they're $2 or $3 million off. Maybe that comes back around to us, because we have been seeing some deals that we're trying to trade early in the year are now starting to come back around because they can't get the number that they want. So it's a little bit of we've got to stick to our guns, stick to what we know, understand what the debt we can get, and not overpay for deals. Where before, people were probably stretching to try and get deals done, in the last 2 or 3 years. So hopefully that answers that question. Recent Co-Star article headline: apartment rents fall in the 3rd straight quarter in the Sun Belt. Yeah, look, it's clickbait. I think real estate is local, hyper local. You've got to understand what you're buying, what that lease trade at is. High level, yes, rents are going to ease off. They're not just going to keep going up and up and up and up. We've seen historical, just a double-digit, rent growth in some markets across the United States. If you're still looking to add value to your asset and looking to increase, turn the rent roll, and again, what a renovated product will rent for. We know in Phoenix and in Texas and in South Carolina, a renovated 1-bedroom, with some really nice finishes is probably $1,200 to $1,300. A renovated 2-bedroom is somewhere between $1,400 to $1,600, maybe even $1,700, depending on where you are in a Phoenix versus an Austin versus a Greenville. So I don't see that changing too much. I don't see it going back down to $800. I still see it staying around those numbers, but you might drop here $25, $30, $50 here every now and then. And again, we're in that Class B space. So hopefully that answers that question. Can you share more color on the spread of interest in cap rates and the lag in cap rates moving as rates continue to rise? Look, that's what we're sort of saying, I guess, is from the whole conclusion of this presentation, is that we are seeing cap rates adjust, but it's taking a lag. It's typically, if I was to bet on it, 6 months. Again, you have to be underwriting deals to every day to see where those lags are occurring. We're seeing about 6 months. Doesn't necessarily mean that is a global statement for every single market. It just means that that's what we're seeing in today. So we have, as Josh said, we have seen certain vintage assets go from 4 to 5 to 5.5% in a 6-month period. Again, that's tracking pretty closely with how quickly interest rates rise. So if interest rates stay at a 4.5, 5 next year, I could imagine you're going to see cap rates still staying around that level until they, until interest rates drop back down again. So it is really tied to that interest rate climb and increase and decrease.
That's it. And I'll quickly add to that you got to remember, this is the quickest interest rate rise in modern history.
Correct.
So normally interest rates rise slower and the real estate market has time to catch up. Everyone's caught off guard here. And that's exactly what Reid was speaking to earlier about the seller expectations and everything just not matching right now. So it'll take some time to level off.
Yep. Exit cap rates here from Rob. I know Rob personally. He's a good friend. Where's your team projecting exit cap rates in relation to SOFR and the Treasury rate projections? Is your team still being capital disciplined in anticipation of spreads between yield of cost and exit cap? So, in layman's terms, what's your going in cap? What's your exit cap? And what do you do? What's that spread look like? Again, it depends on what your going in cap rate is. And that goes back to the question of where going in cap rates. Like I looked at a deal the other day. It was a LIHTC deal. It was a LIHTC deal with a burn off in I think it was 24 months, Josh, was it? I think it was 24 months. But some of the rents on that deal were as low as $250. The cap rate going in was less than 2%, but the price per pound was only $140,000 a door in a very hot market of a submarket of Phoenix. Now, the problem was not that, well, the problem, I believe in $140K a door for a 2000 vintage asset in Phoenix at a 2 cap rate, right? The problem was I couldn't get it financed because when interest rates are at 6.5, I can't get leverage. I don't think I could own it. I think it was a $20 million deal. I couldn't even get a $6 million leverage on that thing. So you're going and having to, pretty much buy it all cash. So that's an example of, backing into what I still believe in that particular deal. I did, but the cap rate didn't make sense. And thus the lending didn't make sense. Thus we couldn't, maybe not necessarily go forward with it, but I still believed in the deal itself. In terms of just an average, you're going in at 5 cap, we're probably doing 150 basis points spread today. Historically, it's been 50 basis points, 10 basis points a year for every year hold. I think, going and exiting at a 6 or 6.5 cap is very conservative today. But that's typically, we want to be extra conservative given where we are today. So hopefully that answers that question.
Clock, Reid. We've got
clock here.
Minutes left. So you probably got time for 2 or 3 more questions.
2 or 3 more questions. And then what we'll try and do is we'll collect all these answers or questions, I should say, and we'll try and answer them in FAQ and send them out in the next day or two. Let's look at alternative assets. Right now, we aren't. We're still sticking with the value add multifamily, but we're just doing a different flavor. So looking at LIHTC burn-offs, looking at burn-off of say a senior housing deal that you can take to conventional multifamily, or a student housing deal taken to conventional multifamily, or assuming in a debt that's already on a property. So we're still sticking to what we know. It's just a different flavor of multifamily. We still think the affordable space is really important. Thus, we're looking at tax abatement states where we can come in and really drastically reduce our real estate taxes and partner up with a nonprofit. And that's how we still skin that cat, so to speak. So it's still value add multi. It's just in a slightly different lane. We've got one here from Kiki. In terms of acquisitions, where would you like? Do you like term loan assumptions to achieve a more favorable debt rate? I expect that requires bank approval. Under what conditions would they want to allow you to assume the loan when they could no doubt double their interest given that the rates have doubled? Very good question. Yeah, we're only just starting to entertain some assumable loan deals. I've done one assumable loan in the past. It hasn't really been an issue, to be honest. The one we're just doing here in Rockport, Texas, it's a Freddie deal. We're coming in with a strong GP team. They're still, they're still locked in, per the loan agreement. Each loan will be different, and each clause in the loan contract, they could maybe there's a clause that they could come and say call the loan due upon an assumability, but then it's not really assumable, so the deal doesn't work. So we are only truly looking at assumable loan deals, and we've got a big, strong bank balance and net worth and liquidity and experience to come in and take over debts at decent rates. All right, we've got 2 more minutes left. I'll try and answer. What do we got here? Can you touch on the tax strategy again? Yeah, look, that was just, so the tax strategy is just across certain states, AMIs are increasing, average median household incomes. The HUD releases quote unquote affordable rents at certain levels. So 20% affordable, 40% affordable, 60% affordable, 80% affordable. And if you can meet certain standards, i.e. say you keep a certain amount of your property at 60% AMI, then sometimes, again, back to that rent roll discussion, you can look at your rent roll and say, well, hang on, my 60% AMI or maybe 80% AMI, that's affordable in this market. The rents are still, for 80% AMI in a one bedroom might be $1,200, but I might be seeing rents on the rent roll at $800. Well, I can have my cake and eat it too. I can be under the preview of affordable, keeping my rents at 80% AMI or less, but then also have my cake and eat it too and get my taxes wiped off, which helps the cash flow out of the gate in higher debt markets. So it's a strategy we've done in a couple of different states. Greenville was the latest state we just did it in. With that being said, we've got 3 minutes. I don't think there's too many other major questions here. Anything we've missed, yeah, please, we'll reach out with any questions. I hope you guys have found this valuable. If you have found this valuable, please let us know. We want to do these probably on a 6-monthly basis because the markets are changing so quickly. And it just helps investors stay in touch with what we're doing here at RSN. If you haven't seen a deal from us, you now know why. But we're trying to get a deal done between now and the end of the year, or maybe even Q1 next year. So please keep a lookout on the emails. In the meantime, please reach out to Ben or Josh or the team or Juan if you have any questions. We really, really thank you so much for taking some time out of your day to join us on this webinar, and yeah, enjoy the holiday season coming up. Stay warm wherever you are, and we'll chat here in the new year.
Indeed. Thanks, guys. Bye for now.